Hello, this is Dr. Ken Morlino from Wilmington University. This video reviews the two methods of presenting cost data in income statement formats. The two methods are the variable or contribution margin income statement, and the second method is the absorption costing income statement. This video uses text examples from Chapter 6, Managerial Accounting, Garrison 16th edition McGraw-Hill. You may want to stop the video at key points to study the exhibits so you can better follow the calculations and formats. I'd like to review a few key conceptual points before we get into the example. First, these examples are specific to manufacturing firms, and so we are accounting for manufacturing expenses or cost. And please note that the term expenses and cost are used synonymously. The variable, the contribution margin income statement, has an internal focus. As you know, the contribution margins format handles all fixed costs as period costs. Fixed costs are not assigned to a particular product in this example, and this contribution margin income statement format is used to help managers make better decisions. On the other hand, the absorption costing income statement assigns fixed overhead costs as a product, not a period cost. And the absorption format has a greater impact on inventory valuation. And these differences will become a little bit clearer as we go through the example. The absorption method is used for external financial reporting purposes on the income statement. And each method may produce different operating income figures, which is dependent upon the inventory values increasing and decreasing. Take a few minutes to study this chart. Understanding the flow of costs from inventory accounts, which are assets on the balance sheet, to the income statement as cost of goods or period cost as expenses is very important in this example. As I mentioned, the key difference is how fixed manufacturing overhead is treated between the two methods. In the absorption method, fixed manufacturing overhead is included as a product cost, an indirect product cost, and therefore it is held on the balance sheet as an asset until units are sold and transferred to the income statement. In comparison, in the variable costing or contribution margin income statement, all fixed manufacturing is treated as a period expense and brought directly to the income statement in the period in which those costs are incurred. Now, in this slide, we'll look at the data that we will be using in this example. As in most cases, a careful review of the given data is key to understanding each method. Notice, we're given a sales price, $100,000 per aircraft. We are given direct manufacturing costs of materials and labor on a per aircraft basis. We see the indirect manufacturing costs, both variable and fixed manufacturing overhead. We see selling and administrative expenses, again both variable and fixed. And then finally at the bottom we see the inventory values, beginning inventory for the period, the number of units produced and sold, the ending inventory value, and of course the ending inventory for the first month of January becomes the beginning inventory for the next month, February, and so on. So we will look at the variable costing or the contribution margin income statement first. So our first steps in preparing a contribution margin income statement is to categorize all of the various costs as either variable or fixed. And so using the given information, we can see up top the variable direct and indirect product costs, and below them we'll pull out the variable selling and administrative costs, and then we can categorize all of the fixed costs, which includes manufacturing overhead and the selling and administrative expenses. Let's prepare the contribution margin income statement using Excel, which is a great tool to do these sorts of tasks. First, let's format the contribution margin statement format here on the left, where we'll start with sales. We'll list each of the variable expenses. We'll create a line item for contribution margin. We'll list all of the fixed expenses, and then we'll determine ultimately the net operating income and loss. Next, enter the given information on per unit values for each of the cost categories, and these are the values that were given to us in the beginning of the example. Our next step in preparing the Excel spreadsheet is to enter the various periods, which in our case are the 3 months, January, February, and March. Fill in the fixed expenses. As you can see, the fixed expenses in a variable contribution margin statement format do not change. So the fixed expenses are $70,000 of overhead for each month and $20,000 of selling administrative for each month, and then enter formulas for all of the various categories here where you would see 0. Finally, then enter the units sold, which will fill in the spreadsheet. There was 1 unit sold in January, 1 in February, and 5 units sold in March, and we see the final or the completed contribution margin income statement. We have sales at the top based on the units sold. We have our total variable expenses, which again are based on the units sold, and contribution margin for each, less total fixed expenses, and our net operating income for each month, January, February, and March. Here is the completed variable cost contribution margin income statement using the given data and also as presented in the textbook. Now let's take a look at the preparation of the absorption costing income statement method. So as mentioned earlier, the absorption method includes fixed manufacturing as a product cost, and we allocate the fixed manufacturing overhead as a function of the number of units produced in each period. So in our example, to calculate the product costs using absorption method for each month, January, February, and March, we include the direct materials, labor, variable manufacturing overhead given, and then we look at the fixed manufacturing overhead and we allocate it based on the number of units produced. So our fixed manufacturing overhead is $70,000 per month, and there was 1 unit produced in January, so the fixed overhead is in January is $70,000. There were 2 units produced in February, and therefore the per unit overhead is 35, and 4 units produced, 70 divided by 4 is 17,500 per unit. So our absorption costing unit product cost are shown below: 95, 60, and 42,500 for the months of January, February, and March. So here we see the final prepared absorption cost income statement. And notice that the format on the left is very consistent with what you would see on an externally reported financial income statement, starting with top line sales less cost of goods sold, and the difference is the gross margin. And so notice that the cost of goods sold is determined by the product cost times the number of units sold for that period. And notice finally that the net operating income for the months of January, February, March are different than the reported net operating income on the internal contribution margin income statement format. Finally, let's reconcile the two methods. And as I mentioned before, the difference between the two methods depends on how fixed manufacturing cost is allocated. And the reconciliation depends on the flow of fixed manufacturing cost as an inventoried cost on the balance sheet. So notice, in January, 1 unit produced and 1 unit is sold. Therefore, no fixed manufacturing overhead is carried as an inventory or an asset valuation. Secondly, in February, 2 units are produced, but only 1 unit is sold. Therefore, half of the fixed manufacturing cost, or $35,000, is categorized as carried over as inventory. And finally, notice that just while 4 units are produced, 5 are sold. There was 1 unit left from February inventory, which was sold in March. So therefore, there was no ending inventory that includes fixed manufacturing overhead. And finally, we can compare the net operating income between the two income statement formats and see that the handling of the fixed manufacturing overhead is the key difference. I hope that you find this video useful in understanding the preparation and differences between the contribution margin and absorption costing formats for income statements.